Shares of Zillow on track for their worst day in 6 years, taking it on the chin this morning after quarterly revenue miss and weaker than expected guidance. The company also announcing it has agreed to acquire Mortgage Lenders of America, a Zillow advertiser, for an undisclosed sum. CEO Spencer Rascoff joined Squawk Box earlier this morning to talk about the stock reaction.
Anytime the stock price reacts negatively, it's a little bit painful in the short term. I think the reason the stock is reacting the way it is because we lowered guidance due to one of our 4 marketplaces, rentals, about 10% of revenue, missing its revenue results. And so we lowered guidance for the year. I don't think the stock market is reacting negatively to our moves with the Mortgage Lenders of America acquisition, about which I'm very excited.
Joining us now from One Market in San Francisco, RBC lead internet analyst Mark Mahaney. Mark, great to see you today.
Hello, Morgan.
Stock's down 16.5% right now. As you just heard Rascoff say, it's because of the lowered guidance. Do you think that's the reason?
I think that's largely it. You had kind of a trifecta, quadrifecta. They lowered revenue for both their core real estate advertising business as well as for the new homes business, but also lowered profitability for the core real estate advertising business and for the homes business. So it's kind of across the board. I don't think the acquisition really had much to do with it. Look, this company is making a pretty big, sizable new bet. They're going deeper down the funnel, as Spencer Rascoff has talked about. It's a good move, but there's just a lot of execution risk. And what's the evidence of that? Already in a very short period of time, call it 90 days, they've had to reduce their revenue forecast for this new homes unit by about 80%. It's a very tough business to get into. Very challenging business to scale. As an investor, we're going to stay on the sidelines. We downgraded this stock to a hold, 3 months ago for precisely this kind of execution risk. I think Zillow has proven a lot over the last 6 years, so it's a name you want to keep on that radar list. I just don't think you need to buy it now, at least not at this price. If it comes in a lot or they really can prove execution in this new home segment, then you can step in, but we're going to wait for now.
You know, execution risk, I think, being the key phrase that you just mentioned a couple of times. Let me make sure I got this narrative right. This is a software company that's been focused on real estate for the last couple of years. Typically a higher margin business. It's expanding into these new revenue streams, basically buying the real estate, flipping the homes, and then also acquiring a mortgage entity to be able to finance the sale of those homes to some of their customers. That sounds to me like, as you mentioned, a riskier business and also lower margins, right?
I think you've got the narrative completely right. The only thing I toggle with you on is it started off really as an advertising business. So they were selling advertising solutions, selling advertising for real estate agents. That was a large market. They've gained very good share in that market. Now they want to go down the funnel and become kind of a transactions business. And that's there are other companies doing this, but it's very early stage. It's also a very demanding, tough real estate market right now. One of the challenges with the homes business is they're getting sellers to commit to sell homes to Zillow, but then they're taking longer than expected to actually conclude the transactions because sellers want to sell the home to Zillow, but they first have to buy the next home before they can move out of the sold home. And these are tough market conditions for home buyers. Home sales are down year over year for something like 35 straight months. So there are also a lot of macro headwinds. So they're doing this pivot at the same into a very challenging macro condition. It's just macro markets. It's just a very hard pivot right now for Zillow to pull off easily, and they're not pulling it off easily.
So, Mark, it sounds like this whole move, the fact that they could be holding these homes in inventory, not could be, will be in essence, for months and months at a time when the housing market and the rental market may be peaking, is the reason for your hold. How do you see this playing out? What gets you out of this hold position, perhaps back into a buy for them? Is it them limiting the risk here? Is it the overall real estate market stabilizing, them somehow proving they can execute better than they have thus far?
Yeah, I think, John, it's a combination of all those things, plus obviously a lower share price. This thing is trading roughly at 25 times cash flow. That's probably the core business is probably worth that. We think it's a good core business. They built it over a decade, over 12 years now. So they've got a very good position in core U.S. real estate advertising market. Whether this next pivot works, it's not really a pivot, it's really an add-on business. Whether it works or not, I think we're going to take a year, or maybe a year and a half to really figure out whether they can gain traction. We are seeing private companies, though, doing really well in this space. Opendoor is one of those. So we want to, if Opendoor can do it, I don't see any particular reason why Zillow can't either. They can develop those competencies. It's just going to take them a while. And then they also have to make sure that the core business continues to grow at a reasonably good clip. And it has 22% revenue growth for the core business. That's pretty good growth in this environment.
Mark, I want to pivot to Snap. We got shares of Snap are actually up 2% right now as it prepares to release numbers after the close today. The company looking to bounce back after falling short in user and revenue growth last quarter. Given what we saw in terms of misses for Facebook and Twitter, and the downward moves pretty dramatic in both of those stocks on the heels of their results, what are you looking for today from Snap?
I think there's a lot of fear going into the Snap print for good reason. So Twitter had MAUs decline, Google sequentially. Facebook had MAUs decline as well, and I think the over-under here is really just a flat outcome for Snap. Whether the specific number to look at is 191 million daily average users. That's what they printed in the March quarter. The expectation is they print that again in this June quarter. In the U.S., having 81 million daily average users. If they come in a little bit above that, the stock goes up. If below that, the stock goes down. It's going to be pretty straightforward. They've already guided to material revenue growth deceleration. There are a couple of challenges they're working through, trying to improve their application on Android devices, trying to improve the Auctionify, their advertising platform, to get more advertisers to come in. Those are going to still take a few more quarters to play out. In the meantime, it's going to be about the DAUs and whether they can even grow them. And since Facebook and Twitter couldn't, there's skepticism, quite rightly, that Snap can do it this quarter.